For years, the US dollar and the Treasury yields have moved in tandem, a relationship that has served as a key barometer for investors worldwide. Higher Treasury yields have traditionally signaled confidence in the US economy's strength, attracting foreign capital and bolstering the dollar's value. But that relationship is now fracturing, revealing cracks in the foundations of America's financial markets. Recently, we have seen the Treasury yield climbing from 4.16% to 5.42%, a move that would typically coincide with a stronger dollar. Instead, the dollar has dropped by 4.7% against a basket of currencies. According to Goldman Sachs, the correlation between the yields and the dollar has fallen to its lowest level in almost 3 years. Let's try and understand this disconnect. Under normal circumstances, rising yields would indicate a stronger US economy and attract inflows into the US assets, pushing the dollar higher. This time, however, the story is different. The yields are going up because US debt is more risky and due to the fiscal concerns and the policy uncertainty, and at the same time, the dollar is weakening. This dynamic is more commonly associated with emerging markets, and it has investors questioning the very foundations of US financial stability. The recent Moody's downgrade of the US credit rating has further highlighted concerns over the fiscal sustainability. Analysts show that the US credit default swap spread, essentially the market's price for insurance against a US government default, are now at levels comparable to those of Greece and Italy. When a country's currency functions as the global reserve, its stability is underpinned not just by economic fundamentals but also by the confidence that its institutions are above political pressure. Investors are now forced to confront a reality in which that assumption no longer holds true. So, what is the challenge for portfolios out here? The breakdown in the dollar yield correlation poses a new challenge for global investors seeking safe havens. And analysts are pointing out that this changes everything. In the last few years, having the dollar long in the portfolio was a very good stabilizing factor. If all of a sudden the dollar is correlated with risk, then it increases the risk. The divergence between the higher yields, a weaker dollar, and lower equity prices undermines both the common portfolio hedges investors have relied on for long. And this has prompted many to reassess their strategies. This brings us to a time wherein the hedging and diversification both are taking center stage. Investors holding the dollar dominated assets have increasingly moved to hedge their positions, effectively selling the dollar to protect their portfolios. And if the dollar continues to weaken, especially against the euro, yen, Swiss franc, which have all appreciated recently, there is a recommendation to move towards those currencies and even have gold as an additional hedge.